the Fed's statement on the scaling down of bond purchase should be viewed in its totality. Essentially, what the Fed has said is that they will start to scale back the size of their bond purchase if economic growth comes in within their expectation. This does not preclude them reversing or loosening up if growth comes in below expectations. Further, tapering does not equate to tightening, which is still some way off. The Fed has made it clear that the target Fed fund rate will remain low as long as unemployment rate remains above 6.5%. This should be viewed positively, as it suggests that the Fed is getting more positive with the sustainability of US economic growth recovery, and rates, while trending up, will not spike up aggressively actually to choke off growth. A recovering US economy is good for global growth, including of course Asia. For emerging markets, including Asia, which have benefited from this low-cost funds searching for better yields in higher growth regions, there will likely be a period of consolidation as asset prices get repriced lower with the higher discount rate used. However, in the longer term, this will eventually be balanced off when growth filters through to the region. China is currently undergoing a growth rebalancing process that is placing less emphasis on the traditional growth drivers of exports and investments, and placing more emphasis on consumer spending, while at the same time fixing problems like the misallocation of resources, excessive leveraging through shadow banking, and of course dealing with the rising local government debt. This short-term pain as a result of this economic rebalancing and policy reorientation should bring long-term gains, not only for China, but also for the whole region. China rebalancing towards more consumer spending over time will actually offer benefits that will be more lasting if its trading partner are able to successfully expand their direct and indirect access to the Chinese consumer. But however, during this economic transition period, Asian trading partners that have benefited from investment-led growth in China may face headwind to their exports. We think that the authorities may tolerate moderate growth of around 7% for 2013 and 2014. The possibility of a stalling speed, or what we term as a hard landing, essentially GDP growth dip below say 6%, is small and can be avoided. We think the leadership has a minimum GDP growth target in mind, taking cognizance of the need to ensure employment and social stability. Faced with a rising rate scenario, bonds should be underweighted, and we maintain a preference for shorter duration bonds given their lower interest rate risk sensitivity, which should provide some stability to investors' portfolios. High-yield bonds can still provide investors with a reasonable return, owing to their lower interest rate sensitivity and positive correlation with an improving economy. Regional equities is likely to undergo a period of consolidation as they get repriced, but will likely do well further out as growth filters through, pulled up by a recovering US economy. Increasingly, cyclical sectors will outperform defensive sectors like utilities, consumer staples, telecommunications services, and healthcare. This has a lot to do with the strength of the economic growth. Cyclical industries tend to leverage off on a stronger economic growth to deliver superior profit growth.